Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me, I'm Manglam Malu and Pavitra Pari. Good morning. The rallies fizzled a tad bit, right? We opened up closer to that 18,900. As we speak, the Nifty is at that 18,850 and lower than that. So we're holding up in the green. It's still positive, a gain of close to about 0.5%. This would make it the 8th consecutive day of gains for our markets. So we've had a we've had a fantastic run up, a powerful up move, and we are at record levels, uncharted territory. So all that is positive. It's just that we've slipped a tad bit from the top of the trading session. The stocks, the sectors which are gaining, they are all the export-oriented or the global-facing sectors. So IT is on top of the list. The Nifty IT index is up 2.3%. Taking cue from the 4.5% rally that we had on Nasdaq overnight. So those are the big movers. Metals are having a good day. On the losing side, Bajaj Auto drags as the November auto sales numbers have missed street expectations.
Hi Reema, hi Pavitra. Fizzle will be a little harsh.
Reema is looking for bad news at this point.
Given the rally that we've seen, yes, 80 points, mildly off highs, but nothing really to worry. The best part about this morning, however, was that the mid-cap index started out as an underperformer. And now as we speak, that index has moved to the high point of trade with a gain of almost 0.5%, and the advanced decline lines, I mean, they're as far apart as they can be, with the green one above, so that's a big positive. Almost 2,000 stocks in the green for about 800 in the red. So that's good news. We have the three frontline indices, the Sensex and the Nifty, as well as the Nifty bank hitting a record high. The mid-cap index is still about 1.5% away. The question is, when does it go?
All right, so let's see how that one moves. But, for today, like Reema was pointing out, it is the IT pack which is doing well after the kind of underperformance that we saw yesterday. You have Reliance, which is once again doing well. By the way, for the week, it is up over 5%. So that one is looking very good. On the downside, it's autos and FMCG. But FMCG did have a very good day yesterday as well. So that one is seeing a little bit of a cut today. In terms of cues, you now have the US jobs data to track. That will be out on Friday with the big Powell speech out of the way. So that is something that we're tracking. And crude prices have moved up. It's at 87, so don't lose sight of that. That is something that we're going to be monitoring as well. That's the market action. We're going to keep coming back to this, but first up, let me run you through everything that we have lined up for you on the show today. The Nifty and Sensex hit fresh record highs in early trade, powered by a global risk-on rally. As per Chairman Powell signals smaller rate hikes going forward. Mid-caps outperform, IT and metals lead the charge, auto and pharma slip. We'll discuss the way forward for the market with Ashutosh Bhargava of Nippon India Mutual Fund.
Nuclear software is a stock in focus as the Bank of Sydney adopts the company's digital lending platform FinOne Neo. Parag Bhise, the CEO of the company, will join us shortly to discuss more.
Auto sales numbers for the month of November are trickling in. Complete details and analysis coming up for you later on the show.
And we'll put a spotlight on the paints as well as the consumer sector, discuss the impact of volatile crude as well as demand with Avnish Roy of Nuvama Wealth Management.
But first up, let's invite Nucleus Software on our show now. The company recently signed a multi-million-dollar deal with Bank of Sydney, where Bank of Sydney will be adopting one of Nucleus Software's proprietary products on banking, which will help Bank of Sydney help in their digital transformation. We're now joined by the management of the company, the CEO of the company. Morning, sir, and thanks so much for joining in. This is Reema here. First, if you could tell us the quantum of this deal, multi-million, but could you be a little more specific? And what will it take your order book to?
Sorry, Reema. Firstly, I'm so happy to join you here. But those specifics, sorry, we don't share. You can, of course, check them get inputs about them from our financial results. But yes, I would like to say that Bank of Sydney is an extremely important customer for us. We signed up with them a few months back, and in fact, they already started using our products and starting to get value from them. Of course, we have a long way to go. They have massive growth plans in the Australian market, and we are all set to support them now and over the years.
Right. Mr. Bhise, could you tell us, what proportion of your clients currently are using a version just below FinOne, and what's the upselling or upgrading potential here for you?
Okay, so that's a very interesting question. You would probably know that we have, over the years, we've been in this retail lending and transaction banking domain for about 3 decades now, more than 3 decades now. We have focused on only these two areas in the BFI sector. Our erstwhile products were FinOne with the brand name FinOne, which is the retail lending product, and Cash Actwell, which was on the transaction banking side. About a decade back, we completely re-architected these two products and launched FinOne Neo on the retail lending side and Finexia on the transaction banking side. I'm happy to share that these two new products are moving pretty well. There are already close to 70 odd customers on FinOne Neo, which is, of course, our flagship product and faster growing product. Finexia is also doing back. Coming to your specific questions, we have about 150 odd customers who are still using our older generation products. And that's the focus for us to move them to the next generation product as early as possible. I hope I answered your question properly.
All right. Hi, Mr. Vise. Good morning. This is Pavitra. Can you tell us about this AMC revision? You've said that you've made slow but very significant progress on this front. If you could share some details about this.
Yeah, I think we've talked about it earlier, not me, but Mr. Vishnu, who's the MD and the promoter of this company. He is the founder of this company. We have approached many of our customers for significant AMC revisions, which was triggered by a realization that we're probably not requesting or demanding enough value of the services that we are providing to our customers. I'm really thankful to all our customers that almost everyone to whom we have talked to have responded very positively to our requests, and we have already concluded a few contracts and in the process of concluding many more. Of course, this process does time because, as you also said, there is we are requesting for a very significant revision in the AMCs. So it does take time to convert each and every contract, but we are moving steadily and very strongly in this direction.
Mr. Bhise, as of 30th of September, 3 customers were on board with higher pricing from you. That's what you indicated. What does that number stand at as of 30th of November?
I would say a couple of them more have already converted and a lot more in the pipeline.
So what will the number be? 4, 5, 6?
Let's say in the range of 15 or so in this financial year.
15 so far. And what's the extent of the price?
That's what we are targeting, just to be clear.
Okay, so you're expecting that 15 clients will be moved to higher pricing in FY23, right?
Yes.
What's the extent of the price revision? You said it's very steep.
It is steep, but I'll limit my response to that because these are specific informations. We're dealing them with.
On a blended basis?
Sorry?
On a blended basis, could you give the market any indication?
Sorry, very sorry. We in general, we have following a policy of not giving any such predictions, so I'll stand by that. I'm very sorry for that.
All right, we take that point, but we'll try to assess that with the kind of guidance that you will probably provide us with on your overall consolidated basis. So if first half revenues have grown at around 16.5 odd %, could you give us a sense of how the second half is likely to pan out? And on your margins, I mean, they have been volatile all over the place. The second quarter, it was 8.8%, but I remember them being upwards of 20% in the past as well, mid-teens at some point. So what's your outlook on margins for the second half of this year and revenue growth?
Look, as I mentioned, I'll repeat it that we've not been giving any guidance on revenue growth. So I'll not be able to share any more details, but I'll only say that the outlook looks very positive. We're getting very positive responses from our customers, not only on the pricing increase, but also on the traction on the new product. New products, they are moving very well in the market. So I'll limit my response to that. Difficult to give any.
Let me try this another way. The second half of this year, are you likely to do as well as the first half or better?
Yes, I am pretty confident of that.
Okay.
All right, got that. Also, could you take us through, because I think the last time we spoke, you had told us that attrition has been coming down. It is at, one of the lowest levels that we've seen in the past. Can you tell us what's happening on that front? Is this something that you expect going forward as well?
Yes, absolutely. There's positive news on that direction. We are experiencing consistently lower attritions month by month. This is, of course, the market dynamics play a role there. We have also taken very significant steps that we have talked about in the past. There have been multiple times revisions that we have done in our remuneration, so that both these have added to the fact that the attrition has significantly come down, and we hope that it will continue at these levels now.
Okay. So without getting into numbers, if you could tell us how much better would your pipeline be today versus say 6 months ago, just to understand the demand scenario for you?
Look, a pipeline consists of two parts. One, I'll repeat what I said some time back, that a major focus for us is to migrate our existing customers from our older products to new products. So that's a very solid pipeline we have, and on the new logos also, we are doing reasonably well both in India and outside India.
So you said 70 of your current customers are using FinOne Neo, 150 are still to be transported. How many do you think you'll be able to move by the end of this year?
Look, it's a slow process. Numbers I won't be able to say, maybe a few more, but the 70 number that I talked about is a combination of new customers as well as some of our existing customers who have migrated. I would like to say that the FinOne Neo platform specifically is also, the offering is also cloud-based. So we have managed to move faster because of the cloud offerings, and that's how that number of 70 has come in a shorter period relatively.
Mr. Bhise, we'll leave it at that. Thank you very much for joining in. That's Nucleus Software for you. The stock has reacted positively to the statement. It's now up close to about 2.5%. Get into a break. We'll discuss what's buzzing in the commodity space. Manisha Gupta joins in next.
Welcome back. You're still tuned into Trading Hour on CNBC-TV18. For the market, we're seeing quite a good day once again. It's currently around 80 points higher. But let's talk about what's going on in the world of commodities today. Manisha joins us. Manisha, what are you tracking this morning?
Pavitra, thank you so much for that. Well, what a last 24 hours it has been when you look at various asset classes. This has been after the US Fed Chair Powell's testimony, where he has talked about easing the pace of interest rate hikes, and that did wonders for commodities as well. We've seen the US dollar continue to decline further, now trading below 106. So dollar-denominated commodities actually have seen a strength come back on that. And then you have the Chinese statements coming in, the stimulus measures, the reserve ratio cut. All of that also has worked positive for many of these commodities. In the last 24 hours, though, we have seen a strong jump up come in for the crude oil prices. It's trading at a 2-week highs. We saw 3% of a gains come in. The support also came in from the fact that the U.S. inventories declined by 12.6 million barrels. The U.S. production numbers, though, have increased for the previous month by nearly 2.4%. But the markets were supported, feeling that the Chinese oil imports will now start to pick up for the month of September, October, and even November. They have been on the weaker side. The OPEC and allies meeting on radar as well, where the expectation is that they may keep the output unchanged. So the crude oil prices gaining 3% overnight. But for the month of November, they still have slid by nearly 7 to 9% for both those crude varieties there. Precious metals clearly should be on your radar because we've seen very strong gains come in for this one. Overnight gains at around 2% for gold and 5% for silver. And for both of these commodities, we've seen best monthly gain come in for gold since the 2021 and for silver since December 2020 as well. Same is the case with the metal prices. Overnight gains have been very strong, and that is what calculated or led to calculations for the month of November on the higher side as well. So for November, we are 8% up for copper, aluminum gained up by 11%. Very strong gains coming in for zinc as well by 12.5%. The agri-industrial commodities also were big gainers. For the last week, not so much gains, but overnight we've seen 4 to 5% of gains for cotton and rubber, turning it into positive on a monthly basis as well. So rubber is now up 9% for November and cotton gaining by 18% for the month.
All right, Manisha, you're smiling. All the commodities
Oh, yeah.
are up, but can't say the same for a lot of these commodity users. Actually, what we'll do is take a short break, come back on the other side. We'll get chatting with Abneesh Roy. You're watching us here on Trading Hour. The FMCG pack has taken a bit of a backseat in today's trading session, but just the last couple of days, we've seen a big move come by in a lot of the frontline spaces. And also, the paint stocks did well yesterday as oil prices saw a bit of a downtick as well. In fact, there has been a fair amount of volatility, but what does that mean for all the stocks on the whole? We do have Abneesh Roy joining in. Abneesh, the last couple of days we did see all the FMCG stocks back in action. Do you think that was just a trading pop or there was something fundamental? Because the next couple of quarters, what's your visibility on demand and margins?
Sure, thanks. Yeah, definitely there is some profit booking today, but there are three key things to watch out. One, of course, is what's happening on the rural demand. The NREGS data which has come out, that's at a almost 11-month low, 12-month low, which I think is a good thing. We need to see the sustainability because that's the job of the last resort. So if NREGS demand is going down, that means that guy is getting a better paying job. So that's something which looks good. Also, base becomes favorable for the rural demand in H2. So we will see that most companies may be aided by the harsh winter if that happens. The rural volume growth for most companies should see slightly better number. I think structural recovery could still take maybe 1 or 2 quarters for the rural demand. Second bit is definitely on the margin side. We have seen a lot of cool off happening in, say, palm oil, crude also, packaging cost also. Yes, today crude is up, but if you see from the peak of, say, $130+, currently it's around $87. We need to watch out on the INR USD depreciation also because that does impact adversely the demand side. But on an overall basis, most companies should see gross margin expansion, EBITDA margin expansion. Based on all this, our top picks currently will be Hindustan Unilever, Britannia, Dabur, Nestle. We also like Asian Paints, but for Asian Paints, Q3 demand will be a bit weak. Nothing structural. That's because of the short window post the rainfall and the festive season. And the very high base which Asian Paint sees in Q3.
Abneesh, morning. Earlier today we had a chat with Bajaj Auto and they said the bottom has fallen off at the entry level. I know it's not a like-to-like comparison, but just to give an indication or the signaling that you get from the rural market demand or the entry-level demand, it does still paint a pretty dire picture. What gives you confidence that things are incrementally on the mend? Any channel checks that you've done across categories?
Yeah, it's a good question, and we did a lot of channel checks also. So in H2, the rural recovery structural is not happening. Definitely, one more aspect is because biscuits, noodles, and soap players will see better gross margins. Part of that is being flowed back in terms of higher grammage in the lower unit packs. If you see for most category, around 30% is lower unit pack, where last 2 years there was grammage cut. Suddenly you will see that grammage addition is happening, so that will also aid the volume growth. Definitely the good monsoon and the pickup in the other jobs, and that's reflecting in the NREGS. That's also on the positive side. But yes, Q3, Q4, as of now, we are not seeing a big trend reversal structurally. It's more of a base effect and slightly harsher winter and slightly earlier winter, and definitely the other reasons which I mentioned in terms of volumes. So yes, still challenging times, but now we are seeing that the base effect will also play out for the rural demand.
All right, Abneesh, in your note, you have mentioned that for paint, Q3 volumes will be lower. How much of a dip are you factoring in Q3? And then you're also saying that this will, of course, recover in Q4. So what is, the kind of volumes that we should expect in Q3, Q4?
I think still early days. If you see most of the fund managers will see the demand on a 3-year, 4-year basis also. Last many quarters, Asian Paint has been reporting good double-digit CAGR in the volumes. Here, what we are picking up, 1 month is still left, so very difficult to call out that. But yes, even in Q3, November demand has been a bit better than the October demand for paints. This is more of a base effect and the window being short. It is not at all a structural demand issue in terms of paint. In fact, on the other side, because crude has fallen, say, from $130 to 87, titanium dioxide has also corrected. Paint companies now will have more firepower to give incentive and discount also. That should also help. Down trading also has been happening past few quarters in paints. That could also potentially reverse by Q4, and that will help the margin. So I will say that yes, Asian Paint also has got other businesses, so waterproofing, construction chemicals, home decor. I think still they should report good double-digit volume CAGR on a 3-year, 4-year basis. On YOY basis, I think the base effect, etc., will be a challenge, but we need to wait for the December month.
Abneesh, what proportion of gross margin expansion do you think will be plowed back in terms of advertising, and as a result of which, how much will actually flow through to the EBITDA margin and bottom line? I mean, everyone's factoring in EBITDA margin expansion, but chances are that companies who have not invested in advertising, brand building, innovation, etc. for the last 3 years because of COVID, etc., will now go back and use these savings to perhaps grow their market and market share a little more, right? So does that mean that gross margin expansion doesn't actually flow through to the bottom line?
No, it will definitely happen. Paint companies, FMCG companies operate in a band of margins. We have seen that in Tata Consumer in the most challenging GDP slowdown and COVID, did see good improvement of 300 to 400 bips gross margin last 3-4 quarters, because tea saw good deflation for that period. I think that will also happen in soaps, biscuits, noodles, and even in the broader packaging cost related. The improvement will happen. Your point is valid that yes, ad spends will go up, but FMCG companies are also seeing lesser competitive intensity from D2C brands because of the dry up of the liquidity and the kind of valuation bloodbath which has happened. For the private companies, it will be extremely tough times in the D2C space. So we will see that competitive intensity, which was impacting the listed FMCG, that will come down, which is a positive. So I would say that yes, maybe say if you see paint from the peak, there is a 800 to 1000 bips gross margin compression. My sense is if this continues and we see some more correction, a lot of these can come back. So 500 to 600 bips gross margin expansion can happen. For example, Asian Paint currently is operating at a 35% gross margin. They could go back to that 40-42%, say by Q1, if the current scenario sustains. Similarly, on the EBITDA margins from the current 14.5, which they reported in Q2, that should also come back to that 18 to 20% in spite of the higher ad spend. Same thing will happen for the FMCG also.
Not a stock we often talk about, but your thoughts on United Spirits? What are the fundamentals looking like for United Spirits now?
Yeah, it's a good company. The steps taken by the new MD, Hina, has absolutely been well taken by the market also. It's a step in the right direction. The issues are definitely Pernod. India is a must-win market. There has been some price war between UNSP and Pernod in some of the brands, some of the market. Second issue is in H2. Because gas prices have gone up further, glass prices will go up. Glass uses a lot of gas. So essentially in H2, there will be some price hikes which UNSP will get in, say, Bengal, Telangana, Andhra, etc. But partly that will be negated by the higher pressure in terms of the glass inflation. So as of now, we are expecting more improvement in gross margin in the HUL, Britannia, Nestle's of the world and Asian Paints rather than UNSP. So UNSP will be lower in terms of the pecking order.
All right. All right, Avnish, we got that. Thank you very much for joining us and taking us through your call on all of these individual stocks that is on the entire FMCG space that we just spoke about. But with that, it's time for a short break on the show.
Index is up 2.5%. Just take a look at some of these large mid-cap IT names. L&T Tech, 7.5%. Emphasis up 6%. Birlasoft up 5.5%. Persistent 5.5%. L&T Infotech. These are very large companies with revenues of close to $1 billion. And look at the way these stocks have run up today. In fact, the recovery in mid-cap IT started a couple of days ago, ever since markets got the sense that from now on, the rate hike cycle has peaked, and going ahead, we are going to see slower rate hikes, lower rate hikes. Markets started, pricing that in terms of evaluation. Remember, through whole of this year, IT stocks got derated as the US interest rates started going up. But now perhaps there is a bottom to that derating, because from here on, the rate increase is not going to be so much. So IT stocks have completely taken off today, and that's fueling the rally that you can see in the mid-cap space as well. But let's move on and address an important story in the insurance space. The Finance Ministry has proposed changes to the Insurance and IRDA Act and sought comments on the proposed amendments by the 15th of December. What are these changes that are being proposed? Yash is here with the details.
That's correct. The Department of Financial Services has proposed some very, very important amendments when it comes to the IRDAI Act as well as the Insurance Act. And let me tell you, these amendments which have been proposed at this point of time have been the biggest in a very, very long time. As far as the IRDAI Act is concerned, I would start with the amendments there. Here, what the Department of Financial Services has proposed is that the whole-time members of the insurance regulatory body can hold office till the age of 65 years. Currently, they are only allowed to hold their office till the age of 62 years. Now, coming to the most important part, which is the Insurance Act. The first thing here which has come about and which we've been talking about, in fact, we were the first one to report it on August 3rd, is that the Department of Financial Services has said that issuance of composite licenses should be approved. Now, what's a composite license? Composite license is a common license through which a life insurance company can sort of undertake the entire general insurance business or standalone health insurance business, or even can choose one business out of it, for example, health insurance business. At the same time, it works the other way around as well, where general insurance companies can enter into the life insurance business as far as that composite license receiving it from the regulator is concerned. Coming to the next set of amendment, insurance companies may be allowed to distribute other financial products. Now, the input that we get from the industry is that these other financial products could be something like mutual funds, loans, or insurance products of other stream, that is for life it could be distributing general insurance products, or for general distributing life insurance products. This opens up a new business and a revenue stream for insurance companies, but the regulations here will be subject to what the IRDA decides at that time once it gets approved. Next one, minimum capital for new insurance companies. There was a condition that health insurance companies, general insurance companies, life insurance companies have to bring in 100 crore of minimum capital. Reinsurance companies have to bring in 200 crore of minimum capital. That has been removed. Now the minimum capital will be decided basis on the size and the scale of the operations of the new insurance company, and that will be decided by the regulator. The next one, for stake acquisition. Right now, if an entity owns about 5% stake in any insurance company, after that, even if it wants to acquire 1% stake, it has to get the insurance regulator's approval. Now, that approval won't be required till another 5%, which means you can acquire 1, 2, 3% stake without regulatory approval. Once you have to acquire 5% stake over the 5% that you already have, then a regulatory approval will be required. The final one, captive reinsurance. Now, insurance companies will be able to serve as a captive reinsurance companies for their holding company, taking in the entire business on their books.
Right, Yash, thanks a lot for that. So that's about the insurance space right now. But the space to be in is the IT space. Unequivocally, big gains coming by in the large cap IT names. The IT index itself is up about 2.5% odd, but the mid cap IT names are where the action is. We have L&T Tech Services up 8%, Coforge up around 3.5%. In fact, the top 5 gainers in the F&O space, 4 of them belong to the mid-cap IT space. L&T Infotech up 4.5%, Persistence up 6% as well. So, good time to get in Himanshu Gupta of Globe Capital for a quick check on the markets. Himanshu, do you think now it's time for the laggards to move the IT stocks, the metals, the global-facing ones, which have now begun to move?
Good morning to you. Well, yes, I think there is something, some kind of catch-up that has to be done with the IT pack. And if you talk about the Nifty IT index levels, I think the breakout is suggesting that Nifty IT can actually rally towards 32,200, followed by 32,800 in this leg of up move itself, which means nearly 800 to 1,000 points up move in this index can be seen in the very short term. Having said that, I think if you talk about the Nifty odd levels, I think now given the PCR, which is above 1.4 odd levels, I think I would like to wait for a dip in Nifty to go longs. And I think as per me, 18,700, 18,650 is the immediate area of support where fresh longs would be advisable. On the upside, I think 19,000, 19,100 can act as an immediate resistance, within which broadly 400 points zone, some consolidation can be seen. If you talk about the some positional and the medium term targets in this leg of upside, I think 19,500 and 19,800 are the kind of targets that we are working on this leg of in this rally in this leg.
So you're not recommending a buy at these levels, only if the Nifty dips to 18,700, 18,650 thereabout. What about stocks, Himanshu?
Yeah, so going with a couple of buy recommendations. So along with IT, cement is one another sector that's actually showing a lot of strength, and I think this is one sector that can actually show some kind of outperformance in the near term. So Ambuja Cement is one stock that's a buy on which I'm recommending a buy around current levels of 577, 578. Keep a stop loss below 570, and on the upside, targets close to 600 can be seen in Ambuja Cement. Second one is a buy on mid-cap IT, not directly, but related to the sector. It's KPIT Tech, one of the strongest IT play, which has actually managed to recover much ahead of the sector. And when the sector is showing strength, I think some good breakout moves can be seen on KPIT technology. Current level 728 around, we can initiate longs for a target price of 760 and 775. Keep a stop loss below 718. And finally, a cash stock that's Triveni Turbine. That's again looking on the verge of a breakout from a sideways consolidation. So Triveni Turbine can be bought around current levels for a target price of 320, and a stop loss below 294 can be placed here.
All right, Himanshu, thanks a lot for getting us all of those individual recommendations. With that, let's move on and talk about an important political story as well. Voting for the first phase of the Gujarat elections is currently underway. Arun Dhanta of CNN News 18 joins us now straight from the key constituency of Rajkot with the latest updates. Arun?
Well, that's right. I am in Rajkot, a district of Gujarat, and this district has 11 assembly seats. And in 2017, BJP had managed to win 6 seats. 5 had gone to the Congress party. So this seat is very interesting. This is Rajkot West, from where the former Chief Minister of Gujarat, Vijay Rupani, contested. And in fact, Prime Minister Modi contested for the very first time from this very seat as well. But as far as this time around is concerned, 2022, it seems to be a three-cornered fight, but BJP is completely ruling out this. They are saying that there is no space for any other party this time around, because the logic which they are giving, that even in 2017, when people were saying that there were the trio of Hardik Patel, Alpesh Thakur and Jignesh Mevani present, still they managed to form the government in Gujarat. But this time around, Alpesh Thakur is in BJP. Hardik Patel is also contesting on the ticket of BJP, so they are very much confident that this time around they will be reaching some unprecedented heights. Remember, it's been 27 years in Gujarat ever since BJP is in power in Gujarat, and this is the 7th term which they are seeking from the people of Gujarat. The record is of 7 continuous terms is in West Bengal of the left government. So the BJP will be matching that if they managed to form the government in Gujarat. But on the other hand, we had seen that high-octane campaign of Aam Aadmi Party. They were offering free electricity, free water, the same pattern which they followed in Delhi and Punjab. So this is going to be very, very interesting, because Aam Aadmi Party had shown in the municipality election of Surat, they had managed to win 27 seats. So in which way people of Gujarat will be voting this time around, whether it is going to be a three-cornered battle or it is going to be between Congress and the BJP.
All right, Arjun, thanks a lot for joining in and giving us those details. Of course, we don't have to wait for too long. From a stock market standpoint, December 5 is when the second phase of elections happens, and 8th December is by when we will get the results of the Gujarat election. Take a short break. On the other side, we get chatting about...
Back, you're still tuned into Trading Hour on CNBC-TV18, and let's talk about the markets and invite our guest on the show, Ashutosh Bhargava, who's Fund Manager and Head of Equity Research at Nippon India Mutual Fund, joins us now to take some questions. Ashutosh, good morning. Thanks a lot for joining us. I'm going to get straight into the sectors and stocks that you like. So if you can take us through, if in the past few months, has there been any big change that you've put into play in terms of sector allocation?
Not really. So we have been overweight on cyclical sectors, so banks, industrials, and consumer discretionary in general. We have reduced some bit of our overweight in these sectors, but not materially. Overall construct remains same, that we are cyclically biased. in most of our portfolios and positioned more towards domestic demand-oriented stories. And despite some of the recovery in global demand-oriented or global pricing-oriented sectors in recent days, we still think that there are more downside risks to those segments. So pretty much focused on domestic demand-driven cyclical sectors.
Ashutosh, we have never made a high when the rest of the global markets have been in a turmoil. The last couple of times, whenever the markets went to all-time high levels, the rest of the global markets were also at all-time high levels. It was a global synchronized move. This time, it's vastly different. So the question is, can Indian markets continue to stay at all-time high levels while the rest of the markets continue to languish, or do you see a catch-up taking place? We stay where we are, consolidate, but the rest of the global markets catch up and outperform us.
To be honest, when we think of local market or even global markets, what we are very sure about is that any further up move in the market has to be driven by earnings and not multiple expansion. We don't think there is a case for multiple expansion in most market, barring one or two markets like China, etc. In our market, I think the best phase of outperformance versus other market is probably behind. The only good part for our market is that when we think of earning risk, we find a lot of risk to global earnings. But the kind of construct that we have for our market, I think the earning risk is much lesser in our market versus many other markets. So earning would be the focus. Multiple expansion is broadly unlikely. And in that sense, India perhaps would perform in line with most of the markets and not underperform despite a very sharp outperformance over the last 1.5 years.
Right. Just looking at a bunch of the names that are doing extremely well, the valuations out there are also at a record high. Not only are the stocks at a record high. So how much more upside do you see even if we were to, maintain our outperformance as against the world?
So if we do more of a bottom-up kind of, assessment and say for Nifty 50, looking at the target prices, the implied return for Nifty would come at around 13-14% of 1 year's time. And that looks reasonable. Obviously, it will be along with a lot of volatility, but that looks reasonable. There is no clear-cut one or two big sectors where you can expect 25% or above kind of gains. That doesn't look the case. But in different sectors, we find between 5 to 15% kind of upside at a sectoral level. And that should be the kind of return expectation from here on, low teens kind of return expectation that we have. And as I said, it would be very much similar to the earnings growth that we are penciling in for, say, next 12 months, around 16-17% growth over the next 12 months. So pretty much in line with that.
All right, pretty much in line with that. Ashutosh, I request you to please stay on. We're going to take a very quick break and come right back. We have lots more questions for you on the other side.